Hey everyone, welcome back to Your Money Life podcast, episode 272 of the podcast. So make sure wherever you're listening, you like, subscribe, 5-star rate and review the podcast, and also comment. Shout out to the commenter, Joanna, commented on our Spotify page. Make sure you're following on Spotify, Apple Music, wherever you listen, YouTube or watch, wherever you listen or watch, make sure you do that. There's a lot to catch up with this week. First, we'll start out with our market update and what is going on in the markets. Busy times in the markets, as we always know. First and foremost, I mean, I would say the week started off with mixed signals, right? Like there's some gains earlier in a week, last week, and the attempt to hold on to those gains. But the tariff, inflation, those things are obviously themes that are still running around in the market. So earlier in this week, Tuesday, we saw a little bit of a pullback based on those concerns. The trade war between the US and China, those things are still major concerns for the market and investors in the short term, obviously not the long term. So I think right now I've seen it. We're seeing people looking at these opportunities and this pullback and this correction as a buying opportunity, which it should be. We've seen it multiple times. We've gone through this. We've done this podcast for years. We've seen multiple periods in the market and multiple cycles of the market and understanding exactly how to combat that and be patient is a key thing. Yesterday was time for people to go bargain hunting again, as there's a lot of bargains in the market. People were scooping up, beating down names. You saw that the market traded lower, then kind of recovered slightly towards the end of the trading day, but still ended up below. I think the narrative is still the same factors at play. You have the trade war, you have tariffs, you have inflation, you have all these things that are also making it harder for companies, economists, the Fed to predict what's going to go moving forward, what's going to happen moving forward. And if, I think undoubtedly we know that the economy is actually slowing down. That's another big factor. We are actually slowing down. And the Federal Reserve has to just understand if they're going to still cut interest rates and when and how, and that's a big thing. Secondly, earnings season is now upon us. We're seeing different companies announce earnings, starting with the banks. The banks actually seem to have done fairly well. Some of them that announced, and so that's a big thing that's going to play into the markets and their guidance that these companies give. Because again, they're unsure of what's happening and they do see demand destruction. They do see a slowdown in the economy. So that's the one thing you're hearing from a lot of CEOs and CFOs during the guidance so far. And those themes are going to play a part. I think what's ahead, economic data that's going to be released on inflation, housing starts, building permits. This will give us just another snapshot into the economy's health. That's the big thing we're trying to understand is how healthy is this economy right now? Of course, more information on tariffs and the trade war. That's going to be big. You saw Sheen and Temu, I think, said that they sent out a note to all customers that they potentially are raising prices. We'll see if we have a story on that. And just in general, those things are playing a huge part. So I think investors, again, what's the theme for us? Patience, bargain hunting. Those are the huge things that you can really be looking at because if you're understanding that these opportunities for bargains don't come often, you want to take advantage of them. It just makes sense to me. Doesn't it make sense to you? Yes, right? I mean, come on. That makes sense. So let's open up and share for our YouTubers. We're gonna jump into what we got going on. We'll look at the chart a little bit again. Past 5 days, up and down, wild swings, and but still a little bit down. Again, past month we know it's been down. Year to date, we know it's down. I still say we need time. It's going to be a few weeks for a lot of this to play out. So people have to use and exert patience when it comes to this. Exert patience, bargain hunting. Those are the two things you should be doing in this time frame. Let's go to current news. Next, I want to see if there's any more in the on the market. We do see Nvidia, they did sell off based on a quarterly charge tied to exporting its H20 graphics process units or GPUs to China and other destinations due to US export controls. Interesting. Stocks also hit on Wednesday after Federal Chair Jerome Powell said Trump's levies could drive up inflation in the near term and are likely to move us further away from our goal. So those two are going to battle as well. The president and Fed Chair Powell are going to have a battle. The president wants to lower interest rates, while the Fed Chair Powell is saying inflation and different things are going to be affected by these tariffs, and we can't just make a move yet. And he said, despite the fact that this was an analyst saying, despite the fact that Powell said that the dual mandate wasn't currently in opposition, he clearly touched a nerve with investors. And so those things are playing a part in the market. We'll be watching them very, very closely. It's a different time frame than 2023, 2024. So just to note that, but I think bargain hunting and patience are super, super key here. Let's jump into current news. Harvard's tax status is under review. This is actually kind of big news, if you ask me. The Internal Revenue Service is considering rescinding Harvard University's tax exempt status. CNN reports. This is citing anonymous sources. The move follows a request from the White House per multiple outlets, also citing unnamed sources. The administration has blocked more than $2 billion in funding from the university. So yeah, I think this is huge news in the sense of like, is this possible? You could really, all universities, of course, are tax exempt, or at least, if I'm mistaken, is it the public universities and private, if I'm not mistaken? But it's looking like that's at um, jeopardy here for at least for Harvard, um, because a list of demands were sent and not um, adhered to. Which again, I don't. Can you touch these universities in that sense? Is this right? That's a question that we have to ask. Is this right to do so, attacking the universities? But we'll see. That's going to be like I'm thinking about the ripple effect. Could you just go after every university now, every exempt organization? Could you go after nonprofits, churches? That's an interesting precedent to set there. We'll see what happens. Let's move on to the Fed chief. He warned his goals are at risk. We read that in this current article, the prior article on CNBC, where the Fed chair is pretty much saying the levies could drive up inflation, the tariffs could drive up inflation. And he's worried because he has those two mandates: keep unemployment low and to slow down or to at least keep inflation cool. And he said that the economy is veering away from the central bank's objectives of keeping inflation contained and the labor market strong. It's a trend he expects to persist through the remainder of 2025. He was speaking at an economic club of Chicago, and he said trade policies could put the Fed's goal of taming inflation and maintaining growth in tension. Um, so he's pretty much saying, hey, we can't cut rates right now. We're not sure what these effects of the tariffs and the levies are going to be. Thus, we need to be patient, watch, and take action as it comes. But we are predicting that it ain't going to be good for our two mandates. We could potentially move close farther away from our goals. Um, so that's a interesting, point. It kind of makes sense. He's kind of just, forecasting these things, and they all are. I do think we'll have to see. No one knows the impact of levies. No one knows if it's going to be reversed. I mean, day to day, you see things that happen and change. I do think U.S. and China, as I said before, will be going head to head, but other countries have seemed to have adhered, and now changes may happen. The 90-day pause on some, and the lowering to just 10% baseline for other countries. We'll see. I'm really, really curious to see how that plays out. We need more information. Middle skill jobs blow up. They're some of the fastest growing jobs available, but not everyone knows they exist. Radiation therapist, nuclear technician roles don't always require a college degree, but with the right skills, they can earn six figures. Last year saw more than 6 million jobs openings like these, and 72% were in occupations with labor shortages per one analysis. Okay, so middle skill, it's like not high skill, but not low. Okay, I love that. Middle skill, interesting. Radiation therapist, nuclear technician, these jobs are seeming to blow up, which makes sense. Like automation can take away low paying jobs and it can take away some high paying jobs. And I do think it can take away some middle skill jobs as well. But AI automation is going to be, it's really interesting what it's going to do. I was having a discussion, with my wife about understanding what it's going to do in the future for people. I think, of course, we've always talked about selling is going to always be around, right? The skill to sell. A lot of skills I believe will be around, but it's too soon to predict the adoption by average people or middle America or just regular people on AI and how, but it's companies are for sure using. I think there was a stat that said one third of the Y Combinator, which is a huge startup incubator, one third of the Y Combinator applicants, company applicants, you had AI coding for 95% of their startup. So their startup was 95% AI coded. which one third of the companies that apply, which is an incredible stat to think about, like the adoption, especially in startups, high tech, those areas, they're really strong, not kind of really strong. That's a good thing to note. That's one thing to note there as well. So let's jump into Netflix. So Netflix is having an interesting go at it. Netflix is set to report quarterly earnings on Thursday. This is after the market close. Wall Street is optimistic, saying the streaming giant is well positioned to weather economic headwinds. Analysts point out that Netflix doesn't face any direct impact from tariffs. They have little exposure to advertising, and revenue in the quarter is set to climb about 12% year over year to 10.5 billion, helped by price hikes, which they do often. We would know, all of us would know. Um, Makes sense. I think again, Netflix. We've always been understanding and a positive and bullish on their content, the business model, and all these things. I think quarter what we're in quarter one, which is we're looking at like a quarter one. I know quarter four is one of usually their strongest. Quarter one I think is also going to be relatively strong, and so we'll see how investors take to what they've come out with when they report earnings. Let's look into more stories. If there's anything else that we missed, trade war, we talked about it. Pharmaceuticals are coming into the fray as well. Wall Street is set to cut earnings forecasts for the Mag 7. We'll see again. It's uncertainty on what's going on in the current environment, and that's a big reason why. LVMH, Moet Hennessy, Louis Vuitton SC, the juggernaut in the world of luxury fashion that claims some 75 brands under its bespoke 100% Italian leather umbrella, they saw shares drop more than 6% after reporting that sales came in lower than expected. Down 2%, fueled by a 5% decline in its fashion and leather goods business. Interesting. The luxury business is a canary in a diamond mine, and the softness in sales says there may be important problems for the rest of the economy. So people are buying less luxury goods. People with disposable income are beginning to tighten their Birkin strings. They're probably not the only ones feeling a pinch. Interesting. There's probably one reason shares of rival like Curran, Burberry, and Hermes also dipped today. So pretty much LVMH came out with their earnings, said that, hey, sales soft in luxury goods. People with more disposables are not buying as much. That's a bellwether or truth telling into the broader economy. People are taking that as a sign, is that people are pulling things back. The uncertainty is having to pull things back. So interesting. You always want to look at those bellwethers and understand them a little bit and see if there's information you can glean from them. Inflation hits 44-year high. That's interesting. Won't dive into that story. Inflation is cooling. So yeah, we had a lot. There was a lot to look at and absorb, I would say, in the news. Primarily, again, looking at what's going on with themes in the market. Patience, exercising patience, and bargain hunting is the right thing to do now, especially for younger investors. We need to do that, and not even just younger investors. Anyone that's not dying tomorrow. Truthfully. So that's our kind of our update there. Let's dive into something a little bit more fun. We haven't done personal finance questions for a few weeks because we had to really dive into what was going on in the economy, the markets, and things of that nature. So always going to dive into that. But let's do this. Questions of the week. We're going to do rapid fire. We have a couple good ones. So the first one is, how much has the median home price in the US gone up over the past 5 years? So again, we knew that there was a huge boom um, during the COVID pandemic, huge gold rush to buy homes. That pushed the median price up a bit. I think it's up 20 to 30%. I would venture. Um, it's a 39% increase. So I was close. I was actually underselling it. But if you look at the past 5 years, again, the COVID boom kind of generated here in 2021. And even in 2022, we saw a little dip after 2022. But the median home price sits around that 398,000 range. Um, and a 39% increase. So it's driven again by people, you know, inflation. Inflation makes all assets go up. That doesn't, so that's actually a good thing to note. Inflation makes everything go up, right? So it makes obviously the cost of buying things go up, but it makes assets go up as well in a lot of cases, right? Like that's another secondary effect as well. And so you have to understand that. Speaking of tariffs and the things we've discussed so far, there's people doing estimates on how much the iPhone could cost if it were made somewhere else. So, according to recent estimates, how much more could the iPhone 16 Pro Max cost as the result of the new tariffs on China? So, not made somewhere else, but as a result of the new tariffs on China, how much more could the iPhone 16 Pro Max cost? So, the answer is $675 more. All right, I don't know why I was expecting a lot more. But yeah, it would go from $1,199 to $1,874. Sizable increase, but I was seeing people talk about $2,000, $3,000. I think that's if you actually manufactured it in the U.S. versus in China. This is saying what would be the impact of the tariffs. So again, a different question. So that makes sense. Let's do one more. What percentage of the U.S. of households in the U.S. rent rather than own? 40%, I would say. 36%. Interesting, interesting. That is an interesting one. So 36% rent rather than own. I thought it would be around that range. So, folks, we just hit on a bunch of rapid fire current updates and different things. Again, make sure you stay tapped in, share with family and friends. Again, comment. Shout out to Joanna, the commenter. Comment, share with your family and friends. We want everyone listening every week. We're going to continue to do this and continue to increase the literacy that we provide, the way that we shoot and produce this. Because again, we're building something really, really great. So stay tapped in. We will see you next week.